You could be paying the bank for keeping your money in their custody instead of you getting paid some interest on the money you deposited in the bank. If and when Bank of England implement the zero interest rate policy in the United Kingdom. And in the recent development, Bank of England has, quote, decided to cut interest rate, restart quantitative easing, end quote, by Hazard, senior European economic strategist. More so because the economy looked likely to slide into recession, he said. Welcome to my channel. Time to subscribe. In this video, I will provide some useful information about the components of negative interest rate, the how, when, and why, and the impact on the economy. Stay tuned. Negative interest rate was first introduced in 2009 when Sweden initiated the negative minus 0.25%, though it was implemented in 2015. The move was meant to be a short-term strategy to stimulate the stagnant economy and to encourage banks to lend money to businesses to create more jobs to avoid recession. And in England, again, according to Hazard, the economy is at high risk because the manufacturing and the service sector has been performing poorly, which could trigger or enable recession. And to avoid this, the Bank of England has decided to initiate the negative interest rate policy. Well, again, the question is, would this action help to avoid recession? It wouldn't, if recession is inevitable, according to some experts. How this work with banks? According to regulatory requirement, all local banks are required to keep some reserve cash at the central bank. It is often called security deposit. And again, banks collect interest on this cash, meaning the central bank is the custodian of all the money deposited by all local banks like Barclays, Lloyds, etc. And in return, the central bank pays interest to all the money within their safe closet. Therefore, if and when the interest rate paid by central bank is high, the local banks are incentivized to deposit more money into the central bank. But when the interest is low, they are not encouraged to keep money with the central bank. So now think about it. If and when Bank of England cut the interest rate, say, to zero, would the local bank be willing to put money in the bank? No, I don't think so. This is exactly the ripple effect of zero interest rate. And again, you will be surprised to hear that as the rate is reduced to, say, zero, with no interest paid to bank, the banks again would have to pay the central bank for holding their cash, meaning cash deposited at the central bank attract storage charge instead of interest. In effect, local banks would prefer to lend the money to local businesses or individuals who would pay at least a decent interest on the money. However, this is what is expected during negative interest rate policy. So, what is the economic impact of the negative interest rate policy? Well, the general consensus is thus: if and when the central bank implements negative rates, say below 0% if you like, in theory, please note the word in theory, it will boost the economy, more so because it will encourage the populace vis-a-vis businesses to borrow more money and create more jobs, which could result into more spending and will inevitably boost the country GDP. And what is the effect of negative interest rate on your mortgage? However, the effect here is practical, not theory. Quote, if you have a fixed rate mortgage, negative interest rate will have no impact on your mortgage. And for those with variable rate mortgages, the rate could fall a little if the base rate is cut. Again, the drop is likely to be limited by terms and conditions involved with the mortgages. End quote. One may ask, so what happened to savings account as negative interest rate policy is implemented? Well, a very likely possibility is thus. The ripple effect of the cut will have impact on the savings, meaning the interest rate on savings will be reduced to zero, and with time savers may be indebted, charged by the bank at the end of the day. And a low interest rate could, according to some experts, trigger excessive growth and subsequent inflation. In effect, it will reduce the purchasing power because of too much money in circulation, thereby undermining the economic expansion. That said, who benefited from negative interest rate? Well, it appears to me as though the central bank is the beneficiary of this scheme. Why? Because cash deposited in central bank yield a storage charge, as mentioned earlier. Okay, let us examine what happened in Sweden when the interest rate was cut as a case study. When the negative rate was first introduced in Sweden, it encouraged consumers to spend more money, though boost the GDP for a while. Well, the question is, so far, what has been achieved since the introduction of this policy in 2015? Well, given the recent report on the state of the economy, Sweden has terminated its experiment with negative interest rates. The Riksbank, the world's oldest central bank, has now raised the main interest rate from negative 0.25% back to zero. Why? Because according to policy makers, the rate of inflation is now at 1.8%. Time to reevaluate the policy. Negative rate and investors, the impact. Negative interest rates are designed to combat deflation by encouraging people and businesses to borrow and spend money. Since this method has been implemented only a few times in the past, in very different circumstances, their effects are difficult to quantify. It is difficult for investors to find yield in a negative rate economy. Is negative rate worth it? Well, in my opinion, if this is the only available tool to stimulate the economy from sliding into recession, I say yes, go ahead. However, policymakers should realize that this could be a temporary measure for now. Okay, here comes the best part. Subscribe and comment below. Remember, the goal is to generate wealth, build companies, and create jobs. Bye now. See you soon.